All right, I think we'll get started, and if people join a little bit uh, late, that's okay. We want to be respectful of everyone's time. So good afternoon, everyone, and thanks for joining us for this webinar. And we hope things are good for you and your families with all that's been going on lately in our world. And we thought it would be wise for us to provide an opportunity for clients to hear from the investment teams that are managing their portfolios, especially with the COVID-19 chaos that has entered our world and the uncertainty around capital markets. Today, we're very fortunate to have Todd Johnson, Michelle Smith, and Chris Richard join us from BCV. Most, if not all of you, will know Todd, Michelle, and Chris from conversations that you would have had with the portfolio management team with your portfolios. Before I hand things over to them, just a couple of housekeeping items to take care of. If you have any questions that you would like to ask them, there is a question and answer button on your toolbar in the Zoom app. And if you don't see that toolbar, just move your cursor on your computer and the toolbar should show up, and you can just click on the question and answer, and the question will be sent up. We'll try and answer as many questions as we can. We're going to try and keep the session to 45 minutes, just out of respect for everyone's time. This is our first webinar series that we're doing, and so there may be some rookie mistakes that happen, so please bear with us on that. And we'd love your feedback on what you liked, whether you want to see more of these, and things you'd like to see changed as well. So with that, I'm going to pass it over to Chris Richard, who will start things off.
Okay, thanks so much. So appreciate everybody coming on. Brief kind of what we hope to hit, to go over today. I'm going to do the debrief on kind of what happened. From the beginning of the year where everything seemed to be going swimmingly to kind of where we are now, where, there's been a bit of a change. So we're going to go through kind of what happened and what implications had to your investment portfolio. Next, I'll pass over to Michelle, who's going to kind of go through what BCV is doing, highlight our investment philosophy, and then highlight a couple of companies to show, how these companies, while they're having they're still investing in the hard times. These are companies you want to hold through these times and then for a very, very long time after that. And then Michelle will pass it on to Todd to kind of go, what are we doing from here? How are we investing? How are we viewing the financial world right now? So I'll get us started. So as everyone's kind of familiar, probably at the beginning of the year, we started to get news about a new potential virus that was emanating from China. At the beginning, it seemed to be localized. We didn't pay too much attention to it other than just news cases. We were being assured by individuals, mostly out of China, that this was not a big deal and they kind of have it under control. Well, on about the 11th of January, the first person who has passed away from what we now know as COVID-19. Again, being reassured that it is localized in a small community within a town, within a large city in China. So again, we paid attention to it, but we didn't think it had that big of an impact, just because we were being reassured that it wasn't going to really have that big of an impact. Well, 2 weeks later, they shut down an entire city of 11 million people. At this point, we started to get more attention, not only in financial press, regular news outlets were picking it up as well. Again, reassured that this was something that was able to be controlled. Shutting down in a city would pretty much make sure that this didn't escape the walls of this city, and then it would be something that would cure itself in a couple of weeks to a month. Then what happened? It jumped outside of China and started showing itself in Europe, mostly in Italy. And at that point, that's really when the financial markets and most people kind of took notice, because obviously what we were being told was not true. And at the time, we couldn't really identify who patient zero was. So they weren't sure how it got out of China and into Italy. So at that point, that's kind of when the financial markets started to show their strain. Up until that point, however, this is a chart of the S&P 500. We were hitting all-time highs. People were talking about the bull market continuing. everything was doing really well. Business was going well. The only issue that we had was a trade tension between China and the US, which was starting to get fixed. So we were hitting all-time highs, seemed to be on a daily basis. Since the 19th of February until about the 23rd of March, we had a drastic drop down in equity pricing. And this is, again, you can kind of see on the chart, it was fast, it was steep, it was quite significant. And a lot of people were saying, wow, this feels fast. And you know what? It really was. It was the fastest we've ever had in capital markets. We've never had from an all-time high to a bear market any quicker than what we had. So 20 trading days evaporated 20% of the S&P 500. What was behind that, what a lot of people weren't reporting on, and kind of what wasn't getting really observed by normal people in equity markets, was that the fixed income market really was the main reason, I would say, as to why we had such a fast drop in the equity markets. So we were starting to see kind of when we trade with banks here and insurance companies here in Canada, is that the fixed income market was starting to freeze up. And for lack of a better word, it pretty much froze for a couple of weeks. And it wasn't just corporate bonds, wasn't just stuff that we were trading. It was across the board. Anything high grade, anything that was longer duration than a couple of months, really was not getting appropriately bid by a lot of our counterparties. And turns out it wasn't just Canada, it was around the world. So the way we can kind of show this is a chart of the high yield index in the US. And you can see over the span of like about 2 weeks or 7 trading days, the amount of return that was required to hold high yield bonds in the US more than doubled, showing a huge sign of stress. There was just just an absence of buyers out there, and people were hoarding cash, and no one was willing to kind of transact. So because you weren't able to transact, that kind of led to the liquidity, people selling stuff in the equity markets to be able to get liquidity because the bond market just really wasn't open. So what's kind of happened since about the 23rd of March till about now really is central banks around the world have kind of come to the rescue. So here this is a picture of the US, they've mobilized north of almost $2.5–3 trillion worth of programs that are consistently getting announced on a daily basis. A lot of these were really smart programs. A lot of them were hashed up from stuff that happened in the financial crisis. A lot of them are new this time around, specifically for this crisis, designed to unclog we always call it the plumbing of the financial system. Canada isn't on the sidelines here. You can kind of see these are just a list of the programs that have been announced. They seem to be new programs that are getting announced on a daily basis. And this really is to kind of help get money flowing, not only to households, but also within the financial system, right? We kind of might not agree on pricing of what bonds are priced at or stocks are priced at, but at least they're getting priced. At least there's flow within the financial system. And that has really kind of helped prices recover, not only in the stock market, but also in the bond market. So, it's not just, again, not a North American phenomenon. Here is this is up into the end of March, but you can kind of see just the amount of money that is being put to work to kind of help financial systems and individuals, get through this really hard time that we're seeing right now. So 20–30% of a country's GDP being put to work to kind of have a response towards the coronavirus. We think that because countries and governments have done this, we're going to have a faster recovery than if they didn't, right? We're still going to have a long, until we get a vaccine, we're still going to have, these issues of, slowed GDP growth. But because we've had these programs, they're really going to help us, take off from where we would have been if they weren't there. So that's kind of what has happened. I'll pass it over to Michelle to kind of go over our investment philosophy and kind of highlight 2 companies that we're quite excited about.
Thank you, Chris. So you're definitely correct that these are unprecedented times that we're in. However, this is not the first time that BCV has found itself navigating a challenging market. Since BCV's inception in 2007, our blue chip value investment philosophy has been tested. It has been tested through the Great Recession of 2008-2009, the energy price collapse of 2014, followed by Brexit, and Trump's inauguration, to name a few. So what does BCV do in these times to protect client wealth? The answer is simple. We stay the course, and we do so by following these three things. We adhere to our blue chip value investment strategies. We focus on the investment income generated by client portfolios, and we continue to look for attractive investment opportunities for client capital over the long term. I'd like to take this opportunity to briefly review BCV's equity and fixed income strategies. Regarding equities, we follow a value investment philosophy, meaning we seek to purchase high quality companies trading at the market at what we deem to be a fair or below fair valuation. In addition, we ensure all the companies in which we invest not only pay a dividend, but that they grow that dividend over the course of time. And as a reminder, a dividend is a share of profit that management pays out to investors as a reward for investing in their company. From a fixed income perspective, we focus on investment grade and near investment grade bonds issued by Canadian corporations. By doing so, investors are rewarded with additional yield for their corporate exposure. Bond portfolios are diversified by issuer, maturity date, and coupon rate. As I mentioned, BCV only invests in quality. So to further elaborate, a high quality company is a company that is a leader in its industry. It therefore has strong and sustainable competitive advantages, which allows the company to build a moat around its business. As such, the company can consistently deliver stable sales and earnings growth. The company is also in sound financial standing and is overseen by a strong management team. A few examples of high quality companies that we hold at BCV are Sun Life, CN Rail, and Microsoft. It's also these characteristics that allow these companies to stand the test of time and reward shareholders over the long term by way of share buybacks, dividend growth, and ultimately share price appreciation. As I mentioned, BCV focuses on dividend paying and dividend growing companies like Scotiabank. The rationale is threefold. Firstly, dividends create a growing income stream paid into client portfolios, regardless of what is happening in the broader market. Secondly, dividends accelerate wealth accumulation over the long term. And finally, the cash flow from dividends can be used to provide inflation-protected income or capital if necessary. Another way to consider this concept is by breaking down the components of total investment return over time. Total investment return is made up of change in valuation, dividend growth, and dividend yield. So over a 25-year time horizon, you can see that change in valuation represents the majority of total return. However, as time goes on, the growth of the dividend and the dividend yield overtake valuation and contribute nearly 75% to total return. Remember that dividends are paid from profits, so an increasing dividend signifies growing earnings. In turn, growing earnings would be expected to drive long-term share price appreciation. Without the concept of a dividend, investors are depending solely on growth and share price, which, as we know, can be irrational. Thus, dividend-focused investing provides investors stability in all types of markets. To further elaborate on this notion, let's review how a value dividend-focused philosophy has performed in various markets. The following charts compare dividend-paying companies in dark blue versus non-dividend-paying companies in light blue, and the overall market in lime green. You can see here in a bull market, dividend-paying companies delivered an average return of 24.3%, slightly higher than the other strategies. In a bear market, the dividend-paying companies were not hit as hard as non-payers and the overall market, falling by less than 14.5% and 3.5% respectively. Part of this phenomenon is due to the income stream and therefore cushion that the dividend creates. And finally, in all types of markets, the dividend-paying companies outperform the other strategies by a significant 6.9% and 1.7% respectively. This is partly due to the fact that when markets do recover, the dividend-paying companies have less ground to reclaim and therefore can rebound faster. It is with these ideas in mind, we are using the current market environment as an opportunity to buy pieces of great companies at attractive valuations. There's definitely no shortage of high quality companies in this environment. However, BCV continues to focus on the companies that will be winners and will also reward shareholders and investors for their patience throughout this economic cycle. It's during this time that we are reminded of a quote by our beloved Uncle Warren: "Be fearful when others are greedy, and greedy when others are fearful." Finally, I would like to focus your attention on two companies that are widely held across client portfolios and that are stewards of value investing. The Royal Bank of Canada has all the makings of a high-quality company. It's the largest bank in Canada with a strong business and diverse client-focused model, allowing RBC to deliver consistent revenue and earnings growth over time. The bank is increasingly well capitalized and therefore can continue paying and growing its dividend over the course of time. In this next slide, you'll see that the share price of RBC has followed an increasing yet bumpy trajectory since 2005. However, over the same period of time, the dividend has delivered a stable and growing income stream for investors, nearly a textbook example of the concepts that we just covered. The same is true for Johnson & Johnson. J&J meets the criteria of a high-quality company in that it is the largest and most diversified healthcare company in the world. Actually, it's this company's focus on advancing health for humanity that led J&J to announce in late March a lead vaccine candidate for the fight against COVID-19. Human trials are set to begin in September, and the first batches of the vaccine are expected in early 2021. The company is committed to bringing an affordable vaccine to the public, and therefore is producing and distributing the vaccine on a not-for-profit basis. So it's this commitment to community and to humanity that has led J&J to deliver 36 consecutive years of earnings growth. The company boasts an even more impressive dividend track record with over 50 plus years of dividend growth. When J&J reported Q1 2020 earnings early last week, they actually increased their dividend by 6.3%, which demonstrates management's ongoing confidence in the future of the business. Furthermore, J&J is one of the last two US companies in corporate America to maintain a AAA rated balance sheet. That's a higher credit rating than the US government itself. It's these characteristics coupled with the company's resilient business model, strong product pipeline, and focus on corporate strength that lends J&J's share price to withstand all markets. In the next slide, you'll see that the share price of J&J has fallen by nearly 16% less than the S&P 500 since the beginning of this year, thereby providing shareholders stability throughout this current investment storm. The share price performance highlights that dividend-paying companies hold up well in challenging markets and therefore have less ground to regain when the market does recover. So now that you have a stronger understanding of what BCV is doing to protect your wealth, I'd like to invite Todd to discuss where markets and BCV may go from here. Todd?
Thank you, Michelle. Thanks for highlighting a few of our companies we own here at BCV. Thanks, Chris, for kind of giving us a picture of how we got here. So I have this last task of what does BCV do now at this environment where we are currently in the economic environment and current valuations of stocks. What do we see and what are we doing differently than the past or currently now? So Q1 earnings season actually is currently on the way now. And what we've seen is a lot of our businesses are continuing to come up with earnings, and we've seen some reasonable results. Michelle just mentioned J&J actually increased their dividend by 6%. Another company we follow, United Health, actually came out with pretty good earnings, didn't increase their dividend, but kept their outlook. So of course, that is in contrast to a couple of US banks that we own widely for clients that came out with earnings that were substantially less because of growing loan losses. So when you're looking at the markets and we're up strong today, but it could be another day where we're down, they are gyrating significantly because the events that we're dealing with are very unknown. We don't know when markets or our economies will be unleashed again and be able to go back to work, whether that will be a month, 2 months from now, whether it will be longer. But I think when you look at the types of businesses and companies that BCV owns, you want to be comfort that whether it's a month from now, 3 months from now, or even a year from now, none of our businesses are facing liquidity challenges. None of them are sustainably long-term are a doubt. It's just simply a timing mechanism. Now that's not enjoyable for anybody that owns a company. We all want our businesses and companies to kind of rise smoothly over time. But unfortunately, that's just not the way markets work. When markets are trying to value the future on an ongoing basis, and there's lots of different trading mechanisms at play, that gyrating market prices and uncertainty in the short term can have massive impacts in the valuation of any companies. So while this crisis unduly will unnerve many different types of businesses, it will not affect substantially the businesses of BCV. They will continue to thrive, 2-3 years from now, and manage through this difficult environment. So I thought it would be good to go over one of our perhaps most famous investors who has a long-term track record that is somewhat similar to BCV's in this regard, and whom we take a lot of certain philosophies and principles from. In some sense, what would Warren do? So we've seen 2019 especially an incredibly strong year in capital markets. Actually, 2018 wasn't very strong, and I think 2020 will probably end to be a very challenging year. But 1-year return should not be something one focuses on too largely. What you want is your 3 to 5 year rolling average to be compounding at what you need to fund your retirement longer term. So that's what we focus on, making sure that the companies that we own, still their 3 to 5 year outlook and their ability to normalize and grow their earnings is still intact, even if they're going through a challenging year environment. And this is another thing that's somewhat interesting. There's certain buy and selling, and certainly we wouldn't want the market to close for 5 years, but if it did, how concerned would we be that our companies would be able to continue their business and thrive 5 years from now? We wouldn't have we have lots of confidence in that. This is something actually what we've seen in March when markets were falling tremendously. A lot of that was actually leveraged trades as well. There's a lot of trading that goes on behind the scenes that's computer-driven trading that is based on certain types of risk parity models and instantaneous trading. And when prices dislocate and start falling very quickly, there's certain trades that have to be unwound very quickly. And so what you found was a bit of a liquidation trade in March where there was a large gap down. That doesn't affect us at BCV in the long term because our businesses, aren't affected by a 1-month drop in stock prices in any significant way. We kind of contrast with perhaps the conventional view on risk. Risk to us is not volatility. Gyrating stock prices is not what we think is risk. Risk is doing something in the long term that won't end up in a profit. So we believe knowing our businesses, knowing them intensely, and understanding them and operating within our circle of competence will ensure that our businesses over time are going to lead to a good a satisfactory outcome. Investing and not understanding the risk is to us where true losses come from, and which is that more or less that next point. And this is another interesting comment. Lots of investors like to look at the current news or even the recent past and extrapolate that into the future. We find that's a very poor investment philosophy. However, it seems somewhat right. Somehow it just happened in the past, or what I'm looking at now is therefore what's going to happen in the future. But as you can see, the quote by Warren, it's difficult to see looking forward. So what you have, you can't see looking forward. You have to know what you own. You have to understand that businesses that you own, in whether they're going to go through a good environment or whether the environment's going to be very difficult and challenging, that you need to have a certain amount of resiliency. And that comes from knowing what you own and ensuring that your businesses have a lot of competitive advantages and operating industries that are going to be resilient through a crisis and do well in good times. And this is actually another interesting comment. Warren Buffett invests in a lot of conservative businesses. BCV's focuses on quality and value and conservative businesses. But stock markets, sometimes decline by a lot. And what we've seen, especially in March, there was a massive decline, and we've seen bigger declines than that back in the financial crisis of 12, 13 years ago. So one has to understand that even though markets fall 50%, the value of any company doesn't really fall 50% necessarily in 1 year. In fact, it rarely does. But yet markets overemphasize, they over-exaggerate, and so unfortunately, owning public market securities, one has to understand that there's a certain level of volatility that's not really risk, but unfortunately gets translated into prices in the short term. So we sent out this graph about 4 weeks ago, just to give clients a sense of what's happened in the past since 1973 till 2020. And this is the largest 500 companies in the US, just as a perspective. to see the different events, Black Monday, which is, back in 1987, where markets fell tremendously, also computer-driven, algorithmic related. The Great Financial Crisis, which is more recent. So, in going through those events, it's easy to be dark and gloomy and say, well, this is, I don't know how we're going to get out of this. So I would encourage you not to look at this crisis, even though there's massive spiraling unemployment, and there's huge government deficits that are being thrown, and businesses are going to have awful earnings this year. But we will go back to work. Some businesses and some companies will not make it. They'll have to be restructured. Those will not be the businesses that we currently own. But the world will recover. We will go back to work. The economy will recover, and the prices of equities will normalize over time. And so with that, we are very confident. So what we would say is, control what you can control. Fortunately, the media and news are informative, but they also are there to sell ads, and they're also there to get eyeballs. And sometimes the media packages news in a very a format that isn't necessarily objective. And so, looking at your long-term financial plan, the income you need off your portfolio, because that matters in the long term, rather than watching the news necessarily and then making an instantaneous judgment. So at BCV, you can see those kind of taglines: quality, value, dividend growth, patience, concentration. Those are our cores, and that's what we continue to focus on in managing these portfolios through these troubling times. And with that, back to you, Vince. If you have any questions, we'd be happy to take them.
That's great. Thanks, guys. Appreciate that. There's just a few questions that have come through, and I think the first one I'll throw towards Chris, just to see Todd slide out of the way, and Chris, there we go. Beautiful. So the first question is, why are the bond markets in Canadian bonds only?
We really do view the bond portfolio as a risk mitigator, and we don't hedge currency. So the depth of market that we have here in Canada is really good. But if we have kind of, a reversal of currency, you could wipe out, a couple of years worth of income returns just by the US dollar doing, going up or down against your Canadian portfolio. We do, on occasion, if someone does want to hold some US securities, we do hold some US bonds, but for the predominant amount, we do trade just Canadian securities. There's not a lot of also dealers here in Canada that more of them trade just Canadian bonds. But if we want to, we could hold US securities. We just find a lot of good value here in Canada.
Okay, thank you. Michelle, is BCV considering investing more outside of Canada due to some of the indicators in Canada, such as its rising debt to GDP?
That's a good question. We're mostly focused on the North American marketplace. We build concentrated portfolios, so we have about 40 names across Canada and US that we're currently investing in across client portfolios. We feel like that is kind of our area of expertise. We like to focus on our companies as intimately and as deeply as we can. So the more we expand our marketplace and geography and industries, the more time and energy and resources that takes up. So we prefer to just focus on what we think is our kind of niche markets, which is here in Canada and the US. With that, with the 40 companies that we do have, a majority of the companies have operations outside of North America, China, South America, Europe, global operations. So we feel a lot of our clients kind of get indirect international exposure that way. So not really looking for any opportunities to change that thesis or philosophy at this point.
So to summarize, basically North America is where you focus, and you get your Goldberg exposure with the multinational firms.
Exactly.
Okay, cool.
Yeah.
Is it wise to invest more at this time, Mr. Richard, or wait until the market stabilizes more? Or is this a good time, or should clients wait? Or what are you recommending at this point for putting cash to work?
Yeah, I mean, if you don't need we always say if you have 3 years to invest, we don't want to have client capital really for the next that's only with us for like 3 months or 6 months, because honestly, we're so headline driven right now. I can't really give you a good confidence to say one way or the other. We're just so, if we have a positive news flow, it could be completely different 3-month time horizon for investing than if we have a negative news flow. What I can tell you though is we've been talking to clients. If you have more capital put into the market, you are going to get a pretty good entry point if we have a 3 to 5 year time horizon. That I can say with pretty good confidence. But we're not picking the bottom being today. We've had more of an elongated, plan for putting capital to work. So whereas we probably would have said, probably a month or 2 months to put in a new portfolio, now we're stretching that out because we are so news heavy that we're just wanting to make sure that we have a good breadth of entry points into the market. So dollar cost averaging is kind of what we've been describing to clients, because really nobody knows what is really going to happen with this virus, because we haven't done this before, right? We've never restarted an economy after stopping it. So those fits and starts might give you better opportunities as we go, but elongating that kind of gives us the best chance to get a good entry point.
Okay, that's good. And I'm assuming that by elongating it and such, that you're also looking at the valuations of where you're allocating the extra dollars. Is that correct?
Yeah, we're always doing that, right? We always want to make sure we're buying the best value we can for clients. We try to make sure that, first of all, that we're on asset mix. We never want to deviate too much from that. We realize that clients have risk parameters that they want to work within. But if we find companies that are hugely discounted from what we think and know is their true intrinsic value, we're not going to wait 5 months to get in. We have confidence in all 40 businesses that we own. We're going to buy them today, knowing that over the next long 3-6 months to a year, we're going to be right. However, if we're in a kind of negative news flow, we might hold off a little bit. So it really is kind of that art and science of putting capital to work for clients.
Okay, excellent. I'm going to move the question over to Mr. Todd Johnson. And Todd, are you guys more interested in Canada or the US in the allocation balance that you're looking at when you're deploying capital?
Yeah, so Michelle correctly said that we focus on North America. In building portfolios, there's a bit of a dichotomy. Canada generally is cheaper, so valuations favor Canada. So you've seen a variety of our businesses in Canada to attract at higher dividend yields and cheaper valuations. But Canada has some structural issues of high household debt, and of course now a very larger increasing federal debt and provincial debt. So there's an uncertainty on the debt side, and we do structurally somewhat grow slower on a productivity basis than the U.S. So those are the positive and negatives. And in the U.S., it's massively outperformed Canada over the last 5 years. So a lot of our businesses there have grown faster, but they're more expensive. So you face a growth versus value challenge as you build a portfolio. So generally, when we build a portfolio, we'll have about half in Canada and half in US on an equity portfolio. That's more or less pretty close. But the portfolio manager has discretion when they build the portfolio because certain things may have changed in the short term. So that's are we biasing a little heavier US versus Canada? It's a bit more company specific. So you might find a little higher weights, but if you had to put me down, I'd be close to even, but maybe slightly more US, given that high household debt in Canada is going to constrain consumer spending. But many of our Canadian companies are not levered as much to the consumer as one might think. Banks notwithstanding, the rest of our businesses in Canada have a much more global focus. So so that's my long answer. I hope I roundabout made it make sense.
Yeah, that's great. Okay, so I'm going to switch to the oil and gas sector a little bit. So two-part question. One is, what in the world happened this week when they were paying you to take barrels of oil? I think it bottomed out about they were going to pay $40 to take a barrel of oil. And then secondly, what are your thoughts on the oil and gas sector in Canada going in the near and possibly longer term?
Yeah, so question one, why to go negative? The reason why negative is there's financial investors in the oil markets, and those financial investors are long the contracts. So they expect to roll them to the next month contract. And as they were unwinding those contracts, oil storage is filling up, and investors knew there was there was no seller on the other side, and so there was a dramatic drop in that valuation. There's what's called a U.S. oil ETF that people think they're buying oil on the spot market, but they're actually buying it 1 month forward. And so, given the dislocations in energy, you found that bizarre environment where a contract actually went negative, which had never happened in history before. And unfortunately, that's investors doing things that they don't totally understand, because equities are investments, not futures contracts, and that has to do with what's called contango in the energy markets, and it's not something we would do. Which then transitions to the next thing, which is what's happening with the investments that we do with energy and oil. We own two companies, Canadian Natural Resources and Suncor. The investment team has been reevaluating their balance sheets, their cash flow, extrapolating and talking to analysts and company management about the scenario going forward over the next year. To us, those have long life, attractive reserves, but we're going through a period where the oil price is very low. We know it will recover, but the question is this a recovery over the next 6 months to a year, or is this a 2-year fight with, Saudi and Russia and extrapolating? So we're evaluating that and the outlook for oil in general, but knowing that we own the two most senior, most well-capitalized businesses in the oil patch, and if other businesses go bankrupt, those are not. There's just their future returns going forward in a relatively low oil price environment, because storage is full. So once we get back to actually flying planes and driving cars again, there's a lot of storage that has to be drawn down. So the oil market will recover. It just might be a little longer than what some expect. But definitely, I think 3 to 5 years, I believe it will recover. But the next couple of years, I think it's anybody's guess as to where prices are.
Cool. Thanks, Todd. I'm going to send a question back to Chris. We'll maybe do a couple more here. What is BCV's, what do they feel the long-term impact will be on the economy and markets with all of this debt that governments have been pumping into the economy?
Yeah, I could go for a while on that one. Long story short is we kind of think that we are going to be in this low interest rate environment for a lot longer than people would think, right? We are going to try our darndest as a nation, as a globe, to kind of get some inflation to be able to pay off this, debt that we now have for this for this response to the coronavirus with inflated dollars later on. So we're going to probably keep interest rates relatively low for a very, very long period of time. So when we kind of look at that, we kind of see great that we can pay back, future, pay back debts that we have now with future dollars that are elevated. But then it's kind of those imbalances that kind of happen when you have an elevated, when you have elevated housing markets, when you have a lot of people with a lot of debt. So a couple of things is we just don't think interest rates are going to rise that fast, right? We have a lot of debt. Households are taking on a lot of debt. So a change in interest rate when you have a lot of debt is more impactful than a large interest rate environment or change when you don't have a lot of debt, right? It comes down to cash flow. So that's something I really focus on, but that's why we still think that focusing on the corporate bond market makes sense, right? You're able to get now a multiple rate of return higher than government bonds, and we just don't see a reason for government bonds really to re-rate any higher. So we just kind of see, buying good bonds from good businesses is going to, over the long term, make a lot more sense.
Great. Thanks, Chris. And we're running close to our timeline here. I'm just going to, one more question, and maybe Michelle, you can do this one. Where is your money going right now?
My money?
Yeah, your money.
My personal
I hope that's
money?
not too personal. But,
Yeah, that's a fair question. I'm very much practice what I preach. So my money is at BCV, like the clients that we manage portfolios for. I have a long time horizon, willingness to bear risk and ability to bear risk. So my portfolio is 100% equity. And in this situation, like I mentioned, there's just so many good opportunities here to add to really high quality names that have been unduly kind of hit in the market. But like I said, because my time horizon is long, I have time to ride this out. I'm looking for some opportunities in the companies that have really been depressed. Like Todd was talking about, we've got the energy companies, Suncor, C&Q, have high conviction that, 3 to 5 years out from now, those companies are going to be fine. Strong management, strong balance sheets. So opportunities like that to get into some really great names that have just been extremely depressed due to macro factors in the market.
That's great. Well, I just wanted to thank everyone for attending today, as well as Todd, Michelle, and Chris. Thank you very much for making time to share your insights today. It's been very helpful. For those of you that are attending, if you have any questions that didn't get answered, please reach out to us, let us know, and we'll ensure that all of your questions are answered in a timely basis. And on behalf of Singer Rowford Financial, soon to be Connect Wealth, I want to wish you good health and safety in the days ahead.